What if I told you that one book has created more millionaires than any other investment guide ever written? What if the same principles that made Warren Buffett the world's most successful investor could work for you, regardless of your current knowledge or experience? Today, we're diving deep into The Intelligent Investor by Benjamin Graham, the book Warren Buffett calls by far the best book on investing ever written. This isn't just another investment guide filled with hot stock tips or market predictions. This is the foundation of intelligent investing, a philosophy that has survived market crashes, economic depressions, technological revolutions, and every form of financial chaos imaginable. Benjamin Graham didn't just write about investing. He lived through the 1929 stock market crash, the Great Depression, multiple wars, and decades of market volatility. His principles aren't theoretical. They're battle-tested by the most challenging economic conditions in modern history. What makes this book extraordinary is its focus on protecting your wealth while growing it steadily over time. Graham understood something that most investors miss. The key to investment success isn't about hitting home runs. It's about not striking out. It's about making intelligent decisions based on facts and analysis rather than emotions and speculation. Warren Buffett, who studied under Graham and became his most famous disciple, has used these principles to build one of the greatest fortunes in history. But here's the beautiful truth. These same principles work for ordinary investors with ordinary amounts of money. Over the next 30 minutes, we'll explore Graham's timeless investment philosophy. You'll learn the difference between investing and speculating, how to think about market volatility, the concept of Mr. Market that will change how you view price movements forever, and the margin of safety principle that protects your capital while allowing for substantial gains. We'll also cover the defensive investor strategy for those who want steady returns without constant market monitoring, and the enterprising investor approach for those willing to do more research for potentially higher returns. This isn't about getting rich quick. This is about getting rich intelligently, safely, and sustainably. Let's begin your journey to becoming an intelligent investor. The investor and inflation. Graham begins with a fundamental truth that many investors ignore to their peril. Inflation is the silent killer of wealth. Even modest inflation rates can devastate the purchasing power of your money over time, making this the first challenge every intelligent investor must understand and overcome. Here's the stark reality. If inflation averages just 3% annually, your money loses half its purchasing power in about 23 years. That $100,000 you're saving today will only buy what $50,000 buys now when you retire. This isn't a theoretical problem. It's a mathematical certainty that affects every financial decision you make. Traditional safe investments like savings accounts and government bonds often fail to keep up with inflation after taxes. If your savings account pays 2% interest and inflation runs at 3%, you're actually losing 1% of purchasing power annually, before considering taxes on the interest, which make your real return even worse. This creates what Graham calls the inflation dilemma. Conservative investors seeking safety often choose investments that guarantee they'll become poorer over time in real terms. Meanwhile, aggressive investors seeking to beat inflation often take excessive risks that can destroy their capital entirely. Graham's solution is elegant. Intelligent investors must find the balance between preserving capital and growing it enough to outpace inflation. This requires owning assets that have the potential to increase in value over time, primarily stocks of profitable companies. But here's where Graham's wisdom shines. Stocks aren't just inflation hedges. They're often inflation beneficiaries. Companies can raise prices when their costs increase, maintaining profit margins even during inflationary periods. This makes stocks one of the few assets that can not only keep up with inflation, but potentially exceed it. However, Graham warns against naive stock investing. Simply buying any stocks because they might beat inflation is speculation, not investment. Intelligent investors must understand what they're buying and why they're buying it. The key insight is that businesses with strong competitive positions, stable earnings, and competent management can raise prices to match or exceed inflation rates. These companies essentially have built-in inflation protection that bonds and savings accounts lack. Graham also addresses the timing dilemma many investors face. Should you wait for the right time to invest, or invest consistently regardless of market conditions? His research shows that trying to time investments around inflation cycles is futile. Instead, consistent investment in quality assets over long periods tends to outperform any timing strategy. The historical evidence is compelling. Over long periods, stocks have provided the best protection against inflation while generating real wealth growth. However, this comes with the requirement to endure short-term volatility and occasional significant declines. Graham introduces the concept that intelligent investors must think like business owners rather than stock traders. When you buy stock, you're buying a piece of a business. If that business can maintain and grow its profits during inflationary periods, your ownership stake becomes more valuable over time. This perspective transforms how you view market volatility. Short-term price fluctuations become irrelevant if the underlying business continues generating and growing profits. The key is ensuring you own pieces of businesses that can thrive regardless of economic conditions. Your action step: calculate the real return on your current investments after accounting for inflation and taxes. Are your safe investments actually making you poorer over time? If so, you need to understand why intelligent stock investing, despite its short-term volatility, may be essential for long-term wealth preservation and growth. Remember Graham's warning. The real enemy of the investor is not the stock market, but inflation and the ignorance that leads to poor investment decisions. A century of stock market history. Graham takes us on a fascinating journey through stock market history, revealing patterns and lessons that every intelligent investor must understand. This isn't academic history. It's practical wisdom that can save you from repeating the costly mistakes of previous generations. The most important lesson from market history is that volatility is normal, not exceptional. Markets don't move in straight lines upward. They experience periods of dramatic growth followed by painful declines, often for reasons that seem irrational in hindsight. Graham analyzes the great bull market of the 1920s and the devastating crash of 1929. During the Roaring Twenties, investors convinced themselves that stock prices could only go up. Sound familiar? This same psychology has repeated itself in every generation since. The dot-com bubble of the late 1990s, the housing bubble of the mid-2000s, and numerous smaller bubbles in between. Here's the critical insight. market crashes aren't anomalies to be feared. They're opportunities to be anticipated. Graham shows that investors who maintained their discipline during the 1929 crash and continued buying quality stocks at depressed prices achieved spectacular returns over the following decades. The historical analysis reveals that stocks have provided superior returns to bonds and cash over long periods. But, with an important caveat, you must be able to withstand significant short-term losses. During the Great Depression, stocks lost nearly 90% of their value from peak to trough. Yet investors who held on and continued buying eventually recovered all losses and achieved substantial gains. Graham emphasizes that market history teaches us about human psychology more than economic fundamentals. Markets are driven by two powerful emotions, greed and fear. During bull markets, greed dominates and prices rise far above reasonable valuations. During bear markets, fear takes over and prices fall far below intrinsic values. The intelligent investor learns to profit from this emotional cycle rather than become victim to it. When others are greedy and prices are high, intelligent investors become cautious. When others are fearful and prices are low, intelligent investors become aggressive buyers. One of Graham's most important historical observations is that market predictions are worthless. Professional analysts, economists, and investment experts have consistently failed to predict major market movements. The 1929 crash caught virtually all experts by surprise, as did most subsequent market turning points. This leads to a crucial principle. Don't base your investment strategy on market predictions or economic forecasts. Instead, focus on buying good businesses at reasonable prices and holding them regardless of short-term market movements. Graham's historical analysis also reveals the power of diversification over time. While individual stocks can and do go to zero, broad market indices have always recovered from even the most severe crashes. This doesn't guarantee future performance, but it provides confidence for long-term investing strategies. The century of data shows clear patterns in market cycles. Bull markets typically last longer than bear markets, but bear markets can be severe and painful. Understanding this helps intelligent investors prepare psychologically for inevitable downturns while maintaining faith in long-term wealth building. Graham also notes that each generation of investors believes their circumstances are unique and that historical patterns don't apply to them. This hubris leads to repetition of the same mistakes, buying high during euphoric periods and selling low during panic periods. The historical perspective reveals that technological changes, while dramatic, don't invalidate basic investment principles. The rise of radio, automobiles, computers, and the internet all created investment manias followed by crashes. The technologies were revolutionary, but the investment principles remained the same. Your action step: study market history to understand that volatility is normal and crashes are opportunities for prepared investors. Don't try to predict when these events will occur, but prepare mentally and financially to take advantage of them when they do. Remember Graham's lesson: the investor's chief problem, and even his worst enemy, is likely to be himself. Understanding market history helps you recognize and overcome the psychological traps that destroy most investors' returns. The Investor and Market Fluctuations. This chapter contains one of Graham's most brilliant insights: the allegory of Mr. Market that will fundamentally change how you think about stock price movements forever. Understanding this concept is essential to becoming an intelligent investor. Graham asks you to imagine that you own a piece of a private business, and you have a peculiar business partner named Mr. Market. Every day, Mr. Market shows up at your door with an offer to either buy your share of the business or sell you his share. The price he quotes changes daily based on his mood, the weather, his personal problems, or what he had for breakfast. Some days Mr. Market is euphoric and quotes ridiculously high prices. Other days he's depressed and offers to sell his share for absurdly low amounts. The key insight is this: Mr. Market's daily quotes have nothing to do with the actual value of the business. They simply reflect his emotional state. As an intelligent investor, you have 3 choices each day. Buy from Mr. Market if his price is attractively low, sell to him if his price is unreasonably high, or ignore him completely if his price doesn't make sense either way. The crucial point is that you're never required to act on Mr. Market's quotes. This allegory reveals the fundamental truth about stock markets. Daily price movements are largely driven by emotion, not business fundamentals. The stock market in the short term is a voting machine reflecting popularity and sentiment. In the long term, it's a weighing machine that eventually reflects the true value of businesses. Graham explains that most investors get this backwards. They treat Mr. Market as a wise authority whose daily quotes must be meaningful and acted upon. They buy when he's optimistic, prices are high, and sell when he's pessimistic, prices are low. This guaranteed wealth destruction is the opposite of intelligent investing. The intelligent investor views market volatility as an opportunity, not a threat. When Mr. Market offers to sell you pieces of excellent companies at discount prices during his depressed moods, you should be eager to buy. When he offers to pay premium prices during his manic phases, you should consider selling. This requires emotional discipline that few investors possess. It means buying when the news is bad, the economy looks uncertain, and everyone else is selling. It means selling or holding when the news is good, the economy looks strong, and everyone else is buying. Graham provides historical examples of this principle in action. During the 1973 to 1974 bear market, excellent companies traded at absurdly low prices. Investors who ignored the doom and gloom headlines and bought quality stocks during this period achieved spectacular returns over the following decade. The Mr. Market concept also explains why market timing is so difficult. Trying to predict Mr. Market's daily mood swings is impossible because they're based on emotion and crowd psychology, not rational analysis. Even if you could predict his moods, you'd still need the emotional discipline to act contrary to the crowd. Graham emphasizes that the intelligent investor must develop the proper psychological attitude toward market fluctuations. View them as opportunities to buy and sell advantageously, not as indicators of whether your investments are succeeding or failing. The chapter also addresses the common mistake of evaluating investment performance based on short-term price movements. If you buy stock in an excellent company at a reasonable price, temporary price declines don't make your decision wrong. They might make it more attractive by allowing you to buy more shares at lower prices. This perspective requires thinking like a business owner rather than a stock trader. If you owned a private business, you wouldn't check its value daily or worry about short-term economic fluctuations. You'd focus on whether the business was generating profits and growing over time. Graham warns against the modern obsession with daily portfolio monitoring enabled by technology. Constant price checking makes investors more likely to make emotional decisions based on short-term volatility rather than long-term business performance. The key to applying this wisdom is developing what Graham calls the right mental attitude. You must genuinely believe that market volatility is your friend, not your enemy. This mental shift allows you to profit from the mistakes of emotional investors rather than becoming one yourself. Your action step. Start viewing market declines as sales on quality businesses rather than threats to your wealth. When markets fall significantly, prepare to buy more shares of excellent companies at discounted prices. When markets rise substantially, consider whether your holdings have become overpriced. Remember Graham's wisdom. The intelligent investor is a realist who sells to optimists and buys from pessimists. Portfolio policy for the enterprising investor. Graham divides investors into two categories: defensive investors who want good returns without constant attention to their portfolios, and enterprising investors willing to devote substantial time and effort to achieve superior results. Understanding which category you belong to is crucial for investment success. The enterprising investor isn't necessarily someone with more money or higher intelligence. It's someone willing to spend significant time researching investments, analyzing companies, and actively managing their portfolio. This approach can generate higher returns, but it requires dedication, discipline, and extensive knowledge. Graham's first rule for enterprising investors is brutally honest. If you're not willing to work as hard at investing as you do at your profession, don't try to be an enterprising investor. Half-hearted efforts in investing often produce worse results than simple defensive strategies. For those truly committed to active investing, Graham outlines several strategies that have historically generated superior returns. The key principle underlying all these strategies is finding securities selling for significantly less than their intrinsic value, what Graham calls margin of safety. Strategy 1. Buying unpopular large companies. When well-established companies face temporary problems, their stock prices often fall far below reasonable valuations. Enterprising investors can profit by buying these companies when they're out of favor and holding until the problems resolve or the market recognizes their value. The key is distinguishing between temporary setbacks and permanent decline. Companies with strong balance sheets, established market positions, and competent management often recover from temporary difficulties. The challenge is having the conviction to buy when the news is bad and everyone else is selling. Strategy 2. Purchase of bargain issues. Graham defines bargain issues as stocks selling for less than their liquidation value. Essentially, you're paying less for the stock than you'd receive if the company were dissolved and its assets sold. While rare in modern markets, these opportunities occasionally arise during severe market downturns. This strategy requires extensive financial analysis to determine true liquidation values and significant patience, as these bargains may take years to be recognized by the market. However, the potential returns can be substantial with limited downside risk. Strategy 3. Special situations. These include mergers, acquisitions, reorganizations, and other corporate events that create temporary pricing inefficiencies. Enterprising investors can profit by understanding the details of these situations and buying when the market hasn't fully recognized the value being created. Special situation investing requires legal knowledge, detailed analysis, and often involves shorter holding periods than other value strategies. The returns can be attractive, but the work involved is substantial. Graham emphasizes that enterprising investors must resist the temptation to speculate in popular stocks, emerging industries, or companies with exciting growth prospects but high valuations. History shows that paying high prices for growth, even when the growth materializes, often produces disappointing returns. The enterprising investor must also avoid the common mistake of over-diversification. While defensive investors benefit from broad diversification, enterprising investors with deep knowledge of their holdings may achieve better results with concentrated portfolios of their best ideas. Graham warns against several pitfalls that trap even sophisticated investors. Day trading, market timing, and buying stocks based on tips or rumors are forms of speculation, not intelligent investing. The enterprising investor relies on analysis, patience, and discipline, not luck or intuition. The chapter also addresses the psychological challenges of enterprising investing. You must be comfortable being contrarian, buying when others are selling, and holding unpopular positions for extended periods. This requires strong conviction based on thorough analysis. Graham's most important advice for enterprising investors is to maintain the same margin of safety principle that guides defensive investing. No matter how thorough your analysis, you can be wrong. Buying securities at significant discounts to intrinsic value provides protection against mistakes and unexpected developments. The enterprising approach also requires continuous learning and adaptation. Markets change, new industries emerge, and investment opportunities evolve. Successful enterprising investors must constantly update their knowledge and refine their analytical skills. Your action step: honestly assess whether you have the time, temperament, and commitment to be an enterprising investor. If not, focus on defensive strategies that require less time but still generate satisfactory returns. If yes, begin developing the analytical skills and emotional discipline necessary for active value investing. Remember Graham's warning: the enterprising investor must be prepared to work hard and think independently. There are no shortcuts to investment success. The defensive investor, Graham, recognizes that most investors lack the time, temperament, or inclination to actively research individual stocks and manage portfolios intensively. For these defensive investors, he provides a strategy that requires minimal effort while still achieving satisfactory long-term results. The defensive investor's primary goal isn't to beat the market, but to avoid serious mistakes while earning reasonable returns with minimal stress and time commitment. This approach acknowledges that most people have other priorities and shouldn't feel compelled to become investment experts. Graham's defensive strategy is elegantly simple. Divide your investment portfolio between high-grade stocks and high-grade bonds, with the allocation varying between 25% and 75% in either category, based on market conditions and personal circumstances. The stock component. Index fund investing. Long before index funds became popular, Graham advocated for broad market diversification as the optimal strategy for defensive investors. He recommended buying a representative sample of leading American companies, essentially creating your own index fund. Today's defensive investors have access to low-cost index funds that accomplish this diversification automatically. A broad market index fund gives you ownership in hundreds or thousands of companies. virtually eliminating the risk of individual company failures while capturing the overall growth of the economy. Graham's research showed that this simple approach outperformed the majority of professional money managers over long periods. The reason is mathematical. By eliminating high fees and avoiding the emotional mistakes that plague active investors, index fund investing captures nearly the full return of the stock market. The bond component: stability and income. The bond portion of the defensive portfolio provides stability during stock market downturns and generates current income. Graham preferred high-grade corporate bonds or government securities with intermediate maturities, 5 to 10 years. The bond allocation serves multiple purposes. It reduces portfolio volatility, provides income during stock market slumps, and gives you funds to rebalance when stocks become attractively priced during market declines. Dynamic asset allocation. Graham's most sophisticated recommendation for defensive investors is varying the stock-bond allocation based on market valuations. When stocks appear expensive, increase the bond allocation. When stocks appear cheap, increase the stock allocation. A simple rule of thumb: when stock market valuations are high price-to-earnings ratios, lean toward a more conservative 50-50 or even 25-75 stocks-bonds allocation. When valuations are low, increase to 75 to 25 in favor of stocks. Dollar cost averaging. For defensive investors making regular contributions to their portfolios, Graham advocates systematic investing regardless of market conditions. This dollar cost averaging approach automatically buys more shares when prices are low and fewer when prices are high. This strategy removes the emotional element from investment timing while taking advantage of market volatility. Over long periods, dollar cost averaging often produces superior results to attempting to time market entries and exits. The beauty of simplicity. The defensive approach's greatest strength is its simplicity. You don't need to analyze companies, predict economic trends, or monitor markets closely. The strategy works automatically, allowing you to focus on other aspects of your life while your wealth grows steadily. Graham emphasizes that defensive investors should ignore market predictions, economic forecasts, and hot stock tips. These distractions often lead to emotional decisions that undermine the strategy's effectiveness. Tax considerations. Defensive investors should maximize tax-advantaged accounts like 401ks and IRAs before investing in taxable accounts. The strategy works even better when you're not paying annual taxes on dividends and capital gains. The psychological advantage. The defensive approach provides enormous psychological benefits. You won't lose sleep worrying about individual stock picks or market timing decisions. The broad diversification and systematic approach eliminate most sources of investment stress. Graham noted that many defensive investors actually achieve better results than enterprising investors because they avoid the emotional mistakes that often plague more active approaches. Your action step. If the defensive approach appeals to you, set up automatic investments into low-cost index funds and high-grade bonds. Choose an allocation you can maintain through both bull and bear markets and stick with it regardless of market conditions or media headlines. Remember Graham's insight. The defensive investor's portfolio requires attention at only a few widely separated intervals. This is one of the great practical advantages of defensive investing. Security analysis for the lay investor. Graham introduces the fundamental principles of analyzing individual securities, making sophisticated analytical concepts accessible to ordinary investors. While not everyone needs to become a security analyst, understanding these principles helps you make better investment decisions and avoid common pitfalls. The foundation of security analysis is understanding the difference between price and value. Price is what you pay. Value is what you get. The stock market constantly quotes prices, but determining value requires analysis of the underlying business. Analyzing the income statement. Start with earnings, the company's profit after all expenses. But Graham warns that earnings can be manipulated through accounting techniques. So look beyond the headline numbers. Focus on sustainable earnings from core business operations rather than one-time gains or accounting gimmicks. Look for consistent earnings growth over time rather than dramatic year-to-year fluctuations. Companies with steady, predictable profits are generally safer investments than those with volatile earnings, even if the volatile companies occasionally show spectacular results. Pay attention to the quality of earnings. Are profits generated by selling more products at higher margins or by financial engineering and cost-cutting that can't be sustained indefinitely? Sustainable competitive advantages that allow companies to maintain pricing power are more valuable than temporary cost reductions. Balance sheet analysis. The balance sheet reveals a company's financial health and stability. Graham emphasizes several key metrics that even casual investors can understand and apply. Look at the debt-to-equity ratio. Companies with excessive debt are vulnerable during economic downturns or industry slumps. While some debt can enhance returns during good times, too much debt can destroy companies during bad times. Examine working capital, current assets minus current liabilities. Positive working capital indicates the company can meet its short-term obligations. Companies with negative working capital may face financial difficulties if business conditions deteriorate. Check the company's cash position. Companies with substantial cash reserves can weather storms, invest in growth opportunities, and take advantage of competitors' weaknesses during difficult periods. Valuation metrics. Graham introduces several simple but powerful metrics for evaluating whether a stock is reasonably priced. The price-to-earnings P/E ratio compares the stock price to annual earnings per share. Lower P/E ratios generally indicate better value, though this must be considered in context of the company's growth prospects and industry conditions. The price-to-book ratio compares the stock price to the company's book value, assets minus liabilities. This helps identify companies selling for less than their liquidation value, a key component of Graham's margin of safety principle. Dividend yield provides current income and often indicates management's confidence in future earnings. Companies that consistently pay and increase dividends demonstrate financial strength and shareholder-friendly policies. Red flags to avoid. Graham identifies several warning signs that should make investors cautious. Companies with declining revenues over multiple years may be in irreversible decline, while temporary setbacks can create opportunities. Persistent revenue declines often indicate fundamental problems. Excessive executive compensation relative to company size and profitability suggests management priorities may not align with shareholder interests. Frequent changes in accounting methods or unusual items in financial statements may indicate management is trying to hide problems or manipulate results. The margin of safety principle. All security analysis ultimately serves one purpose: determining whether you can buy a stock with an adequate margin of safety. This means paying significantly less than your estimate of the company's intrinsic value. The margin of safety protects against three risks: analytical errors in your valuation, unexpected business developments, and general market declines. Even if you're wrong about a company's prospects, a sufficient discount to value can still produce satisfactory returns. Graham suggests that intelligent investors should demand at least a 30 to 50% discount to intrinsic value before purchasing individual stocks. This substantial margin of safety is what separates investment from speculation. Your action step, if you're interested in individual stock analysis, start by learning to read basic financial statements and calculate simple valuation metrics. Focus on understanding businesses you can comprehend, and never invest in companies whose financials you can't analyze confidently. Remember Graham's fundamental principle: investment is most intelligent when it is most businesslike. Treat stock purchases as buying pieces of businesses, not lottery tickets. We've just explored the investment wisdom that has created more wealth than perhaps any other approach in financial history. The Intelligent Investor isn't just a book about making money. It's a philosophy for building lasting wealth while sleeping peacefully at night. Let's recap the timeless principles that can transform your investment results. Think long-term. Act rationally. The stock market is a voting machine in the short run, but a weighing machine in the long run. Focus on business fundamentals, not daily price movements. Embrace Mr. Market's mood swings. View market volatility as your friend, not your enemy. Use emotional extremes as opportunities to buy low and sell high. Maintain your margin of safety. Never pay full price for investments. Always demand a significant discount to intrinsic value to protect against mistakes and unexpected developments. Know yourself as an investor. Choose the defensive approach if you want satisfactory returns with minimal effort, or the enterprising approach if you're willing to work hard for potentially superior results. Let history be your guide. Market crashes are normal and temporary. Bull markets can last longer than bear markets, but both eventually end. Prepare for volatility, don't fear it. Focus on value, not price. Price is what you pay. Value is what you get. Learn to analyze businesses and buy when the market offers excellent companies at reasonable prices. Stay disciplined and patient. And intelligent investing requires the emotional discipline to act contrary to the crowd and the patience to wait for your investments to compound over time. But here's what makes Graham's approach truly revolutionary. It's not about being smarter than other investors or having access to secret information. It's about being more disciplined, more patient, and more rational than the crowd. The investors who have achieved the greatest long-term success, Warren Buffett, Charlie Munger, and countless others, didn't beat the market through superior intelligence or insider knowledge. They beat it through superior temperament and unwavering adherence to time-tested principles. These principles work for any investor with any amount of money. Whether you're starting with $100 or $100,000, the same approach applies. Buy pieces of excellent businesses at reasonable prices and hold them for long periods while reinvesting the profits. The beauty of intelligent investing is that it gets easier over time. As your knowledge and experience grow, as your portfolio compounds, and as you develop the proper psychological attitude toward market fluctuations, the process becomes almost automatic. Your wealth-building journey doesn't require perfect market timing, hot stock tips, or complex strategies. It requires patience, discipline, and adherence to proven principles that have worked for nearly a century. The choice is yours. You can continue being swayed by market emotions, chasing the latest investment fads, and hoping for quick profits. Or you can join the ranks of intelligent investors who build lasting wealth through time-tested principles and disciplined execution. Start today with whatever amount you can invest. If you're a defensive investor, set up automatic investments in low-cost index funds. If you're enterprising, begin learning security analysis and looking for undervalued opportunities. Remember Graham's most important insight. The intelligent investor's worst enemy is not the stock market, but himself. Master your emotions, stick to proven principles, and let time and compound growth work their magic. Your financial future isn't determined by market predictions or economic forecasts. It's determined by the investment principles you follow and the discipline with which you follow them. The path to intelligent investing starts now. The principles are proven. The only question is whether you'll have the wisdom and discipline to follow them.